Good morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. And let's welcome Dimitri Pargamonic to the stage. How you doing, Dimitri?
Good morning, Will. How are you?
Good. And today we're going to be talking about IV crush after earnings.
Yeah, I think this will follow up on the question that we had yesterday and on the email, and it had to do with the implied volatility crush post earnings, and we're going to take a look at it and kind of discuss the implied volatility and option sensitivity to Vega or implied volatility changes. So let's find a stock first with upcoming earnings, and I'm going to go to the earnings calendar here. Let's bring up earnings calendar just so we could kind of see a stock with upcoming earnings and what the implied volatility looks like right now. And on the earnings calendar, you see, let's look at Micron Technologies. They're expected to report today after the market close. So that earnings has not yet been released. So the option should reflect a pre-earnings implied volatility or pre-earnings premium in the options, ahead of that event. So let's go to, I'm going to go to MU. So I'm just going to type it on in here to make it easier. You could click on it. We go to this main page, and from the main page, we have the side menu bar. We're going to click on earnings and then implied moves in IV crush. And let me just minimize the menu to expand our screen. And there are a couple tabs up here regarding implied, looking at historical earnings analytics around options and around earnings. Okay. The one question that we had was specifically implied volatility crush. And here we see some stats here that give us a historical perspective what happened to the implied volatility the day after earnings were released. And this uses, we could see the implied volatility for the IV30. So you could see right now going into the earnings, implied volatility is 59. Right, so it's I'm sorry, that was the last earnings. The last earnings was 59. So this is, so far we haven't reported this earnings, but from the last earnings, it started IV30 at 59. The next day dropped to 43.8, which was a 26% decline. 5 days later, it was 47.1, so indicating that it came back up next 5 days. But if we look at the averages, looking at the last 12 quarters, we could see that the average implied move was down 23% the day after. So this was the last one, but if we averaged out the last 12, on average, the implied volatility dropped 23%. So the average was 53.6, dropped to the next day 40.5. 5 days later, it stayed around the same on average. So we'll tick down a little bit. And if you want to go down and see the data for the last 12, here we have, the day before, the day after for each of these historical earnings. This is the upcoming, so far we don't have this data because the earnings are after the market close. And these are the summary stats. And the question was, well, now that we have these stats, these are the averages, so it's not every time. You could see, that they vary, from quarter to quarter, from 70 to 43, from 55 to 35, sometimes from 37 to 31. So they're not always the same. There's big variation there. These are just looking at the averages. And right now we're around 53.4. And I think that the question was, well, if the implied volatility on average drops, let's say 23%, right? So that's our average. Is that proportional across different expirations? And the answer is no, because that's only looking at the 30-day constant maturity, IV30. So the IV30 represent, when we reference an implied volatility. Well, implied volatility, it's not like a stock price. It's a calculation derived from option prices. So if you're looking at option prices, well, you have to identify what expiration are you looking at and what strikes. So this IV30 is looking for a 30-day constant maturity at the money implied volatility, okay? Which would be different than if we looked at a 7-day at the money implied volatility, or 5-day or 20-day, because implied volatilities have a skew and they're different across different expirations. So this would only statistic only reference the implied volatility 30. Okay. And this gives us kind of just the idea of, we're looking at a monthly option with 30 days to expiration. And we could measure what it is today versus historical, and the historical change decline. So let's come back here, and this is an important question, to the options chain and see what they look like today. So I'm going to open up the menu. I'm going to go to the option chain, and let me again minimize the screen. And here are the different expirations available. But we could see that June 27th, the implied volatility is at 100. That has 2 days left to expiration. Implied volatility June 3rd is 72, June 11th, 60, July 18th, 55. So you could see it keeps going down as you're going out in price. And I think that the thing too that is extremely important as a trader is that when we look at the implied volatility, a decline in implied volatility in a shorter dated option has a different sensitivity than a implied volatility change in a longer dated option. In other words, a decline of one implied volatility click in a June 27th expiration does not translate to the same dollar amount if we reduce the implied volatility by one click in the July 18th expiration. That's because these options, when we look at implied volatility, have different sensitivities. The further out you go, the more sensitive the option is to an implied volatility change. So let's see what that looks like. Let's say we set up a time spread, right? Let's say we go on June 27th. We could see here's a strike with 99. This is the implied volatility bid of this option is 99. So I'm going to click on this, right? And here we're going to set up a time spread. So here you could see that June 27th call, we set up selling one for 550. So when you click on the bid, it just kind of auto populates this for you. And of course, you could just change these parameters if you wanted to. And then I'm going to come out here. Let's go out to July 11th, right? So I'm going to go to July 11th, and I'm going to look at the same strike, right? The same call, the same strike, the 128 strike. And I see that this implied volatility is 61. So I'm going to click on this ask, right? And now I see a time spread. Selling the June 27th 128 call, buying the July 128 call. So we're doing selling one call, buying another call on the same strike but different expirations. But what we observed is that the implied volatilities are different. One is 61, the other one's 99. So keep in mind, though, we're looking at different expirations, and these options have a different sensitivity to implied volatility change. So I'm going to run this analysis for you. And when we run this analysis, here's what we get these stats, but here we get the risk sensitivity of our entire portfolio, right? Selling one, buying one, to option Greeks. And look what you notice, that your portfolio is long Vega. It's long Vega, meaning that if implied volatility decreases proportionally by one vol click, you're losing. By two vol clicks, so what it's saying is that you're actually long volatility. Even though you sold a higher one and bought a lower one, but you're long volatility, meaning you want volatility to go up, not down, because you own an option that has a higher sensitivity to implied volatility move. Let's look at it. So this is what your payout diagram kind of looks like on that first expiration. So I'm going to go here under summary. And let's look at the pricing and risk sensitivity. Click on that. And here we have the same setup. Selling June 27th call with 3 days to expiration, buying the July 11th 128 call, 17 days to expiration. Here's the implied volatility, right? Here is our total risk. So watch what I do. If I open this up, you see this June 27th call, the Vega is 6, right? So it's 6 cents, times 100, because you have 100 contract, 100 deliverable per contract. But the July 11th has a Vega of 11. So, if you're long one, this sensitivity is 11, and you're short the other, this sensitivity is 6. Overall, you're long Vega. So you need this, right? So just think of it this way. I need the June 27 call to decrease by 2 vol clicks for every 1 vol click in June 11th to even out, right? I need 2, because if 2 vol clicks will imply I made 12 cents. I'm short. 1 vol click here, I'm going to lose 11 cents. So you could see here that it's not proportional. If the decline is proportional, 1 for 1, this is not good. It's not good for us, even though one implied volatility is higher than the other. Okay, and that's an important key element to trading time spreads, that you really understand and know that. Okay, you must know this inside out if you're trading time spreads, and especially if you're going to go and look at your portfolio risk and the sensitivity of the implied volatility changes to your portfolio. You cannot assume just because you're trading 2 different expirations, one is 50 and one is 30. Well, that looks, that's it. That's an art. That's not the case here. That means you don't understand the option pricing models. You need to understand your risk. So here we see that we're long Vega. And now the question is, well, what do we expect implied volatilities to move to? And what do we think are profit and losses based on this? So this is kind of like our initial profit and loss on the day, if nothing else changes but the stock moves. Let's say we move forward one day to let's do June 26th, tomorrow. So what I did was decrease 2 days, right? First I decreased 2 days, saying, well, what does our portfolio look like after the earnings? And let's say I and let's just say I think the implied volatilities in both of these will go to, let me see if I have some rough. Let's say I think the implied volatilities in both of these will fall to, let me see if I have some. I'm going to reference a historical here. Here, if we open this, the last 20 days here, the implied volatility moved at 40. Okay, so let's say I give it 40, and I think both of these implied vols will move to 40, right? Which is where the stock has been trading at in the last 20 days. So if that happens, let's type in 40. So this IV will drop by 59. And let's say this drops to 40. So this will drop by 21 vol clicks. Let's run our analysis. So here, this will actually be good for us. So if they both drop to 40, the value of the spread, if the stock doesn't move everything else the same, the stock doesn't move, but we take out 2 days and both of these drop to 40, then the value of this spread will be $2.82. So if you bought it for $1.30, goes to $2.82, that's pretty good. And here we could see that, where that the stock, you also have like a short gamma, so it has to remain in this range. The closer it is to that strike, the better. The further moves away, it's worse, right? Because you're short gamma, right? You're short gamma in this strategy. So you have two things here. You need the implied volatility proportionally to move twice as fast. Let's say it doesn't do that. Let's say that we go back to what was the original? What was this, like 90? This was like something like 99, right? And this was like something like 61. So let's say that they don't move as proportional. Let's say they both kind of move together 10 clicks. So let's just say this moved down, or let's just say 20 clicks, right? So let's say this moved down to 70, right? And this moved down to 41. Right, so this would be not 70, this would be to 80, right? So look, let's say they both move down around 20. Let me fix this up a little. So, hold on a second. What did I miss here? Was it 69? 79. So let's say they both move down 20 clicks, right? So they both move down 20. We've run that analysis. So this would still be good because this decayed 2 days. But you could see that the profits, this is not as wide. So these are things that you would need to go and test out prior to your earnings setup. How sensitive is my position? How much, so this has a decay here factor. Let me come back to here. Let me show you something. So in this situation, you also have a theta. So when you move it up 2 days, if nothing happens, you're positive theta, which means you're collecting, or your portfolio, the decay is in your favor, that the option you're short is is losing value faster than the one that you're long. So you have two things here. You have a vega risk, but you also have a positive theta. All right, so you have a very high theta as well. That's working in your favor. So here, if we go back to 99, it was like 61, right? Oops, what is this? All right, 99. So we go back to let's say our original IV. But look what happens if we just move up 2 days, let's say June 26th, right? So you could see that even with implied vol staying the same, you do have a positive theta, which the value of this spread goes up if implied vol stay exactly the same, and only you move up in time decay. So these are things like to start changing around and you know try to shock your portfolio from different perspectives to see if that lines up with your outlook going forward. So I think I answered that question from the way I understood it.
Yeah, actually, Jim said question answered, and great job, D. Thanks for
Oh,
answering his question. Rob
thank
made
you.
a real nice comment. He says, sometimes the morning show is a really special discussion. Today's was one of those days. Thanks, Jim, for the question.
Oh,
That was nice,
thank
Rob.
you.
Great job, D. Answering the question. Anyone has any questions, you can directly email me, williammcbride@gmail.com, and I will get them to D so they don't get spammed. And we do get so many questions to support and things. So I'll try to get them in front of D if you have them. D, great job as always, my friend.
Thanks. Well, thanks everyone for joining. Stay safe out there, and we hope to see you tomorrow.
All right, we'll see you tomorrow, D. Hey, everyone. Thanks for joining. Jim, thanks for bringing the question. We will see everyone tomorrow. You have a safe, great trading day out there. And remember to like us and follow us on all the social apps. And if you're on YouTube right now, please give us a thumbs up. Great job, everyone. Special thanks for Jim again for the question. Everyone have a great day. Stay safe out there and trade in peace. Bye-bye.